Hello, everyone. Let's try to do the jump from fancy AI to something we think is important, long-term investing. Yeah. So what we are looking on is a new yield environment and how we as multi-asset investors are facing that yield environment. Let's have a look how the yield environment changed over the last 1.5 years. What we have here is how the whole investment environment looked like 1.5 years ago. 1.5 years ago, end of 2021, there was something we called TINA. There is no alternative. What you see here, left-hand side, is what government bonds and corporate bonds in Europe yielded end of 2021. 0. And you see here what we expected as DWS would be the return for European equities, close to 8%. So there was no alternative for equities. How did that change? You see here on the right-hand side, yields are back. You see government bonds in Europe yielding close to 3%, corporate bonds 4.5%. Is that super interesting? We know a lot of investors go super crazy about fixed income. They say, oh, that's the time for fixed income. We would say it is not as unattractive as it has been 1.5 years ago. If you look on the right-hand side, the return perspective for fixed income is still less than for equities. And remember, if you do investments, we as multi-asset investors, we always look on 3 dimensions. One you see here, it's the return dimension. How much return do you expect? The other one is the risk dimension, so volatility. How much volatility do you take if you invest in an asset class? There we need to say fixed income currently is moving way more than historically. You have huge moves on yields on the fixed income side. So from a risk perspective, it doesn't look too attractive. As I said, from a return perspective also, not that attractive. Correlation is the last point we look at. So fixed income makes sense if the correlation to equities will change. Historically, there was a negative correlation between equities and fixed income. So you put together a multi-asset portfolio, and every time equities suffered, fixed income saved the day. So when this correlation perspective changes, we think fixed income could make sense for investors. But from a pure return perspective, it is not as bad as it has been 1.5 years ago, but it's really not outrageous. So that's really the view we have. To look a little bit closer how the changes happened on the fixed income side. So you see on the left-hand side here, the dramatic move fixed income yields did over the last 1.5 years. So for European government bonds and US treasuries, from close to 0 to 4 to 5% return. And remember, the concept is always yields up, price down. So whenever yields rise by 300, 400 basis points, you as a fixed income investor, you lose 10, 15, 20% relating of how long you are, so how much duration you have. So a lot of investors who now think, oh, we suffered 10, 15, 20% from fixed income. This is a huge alternative. We think it just normalized. The fixed income yields just normalized to levels that we've seen 30 to 40 years ago. The 10 years before that have been unusual. So we would think the current yield environment is not as unusual. What has been unusual have been the 10 years before, and that's just corrected. So we would view fixed income yields as neither unattractive nor attractive, something in the middle. What needs to change, as I said, is a correlation. And interestingly, fixed income investors are also seeing it the same. So what we here see on the right-hand side, it's a yield curve of the fixed income market. So for different maturities, what's the yield for different maturities? And you still see that the fixed income market as a whole is pretty depressed. So you can argue fixed income investors are typically depressed. They don't expect too much from macro investments. Otherwise, they would invest in equities. Yeah, typically, equity investors, as we've heard, are more optimistic about the world. But the fixed income market is pretty much depressed still. You see that by the inversion of the curve. Inversion for us means the front-end yield is higher than the back-end yield. So typically, fixed income investors still expect a recession to come, central banks to change and all that. So the fixed income market per se is still pretty much depressed, and the yield at the front end are higher than at the back end. That is still pretty much understood by the market, yeah? Inflation picture changed, central bank reaction policy changed, so the change in fixed income markets, it's pretty much understood by investors. But what on earth happens on the equity side, yeah? Why are equities so much up with this changing yield environment and the changing inflation environment? We think a lot of investors understood last year. You had the first wave of inflation, the first wave of central bank reaction, yields going up, equities went down. This year, inflation is still high, yields are still going up, and equities are performing. Why on earth is that happening? I think the reasoning why that is happening we've heard before. It's 2 letters, AI. That's why equity markets are going up. For us, there's one big question. Typically, themes like AI or whatever we have heard before, it's like an end-of-cycle development. So typically, whenever you need a theme to explain why equity markets are still going up, it's like end of cycle. The question is it the same this year? So is this thematic hype we are currently having more this view of being end of cycle? Or is it different this time because the biggest 7 stocks in the markets are actually standing for the theme? We think this is an important question, and we would say it's a mix of both. So it's somehow end-of-cycle behavior, all this flows going into thematics, but it is different because these 7 names are so improved and well organized with the AI theme that is longer ranging and a longer development. So this is the market environment we are living in. Higher yields, equity markets driven by just 7 stocks. And you have the frenzy of one group of clients just doing money market and short-term cash, and the other group of clients saying, hurrah, we just buy AI. And what we try to do as long-term investors, as multi-asset investors, finding the right mix of your asset allocation, because that was important and successful over 10 to 15 years, to have the right mix and not only doing one side or the other side to find the right mix. So how we deal with a new yield environment is obviously also we change our fixed income allocation. What you see on the left-hand side is for the best and well-known product in multi-asset for DWS, Concept Kaldemorgen, how we managed duration over the last 2 years. You see here the blue shaded area below 0 is where we were outright short duration. So actually we shorted more duration fixed income instruments than we had physical holdings in our portfolio. And remember, yields going up, meaning prices go down. If you shorten assets where prices go down, you make return for your investors. So actually, over the last 2 years till end of 2022, we generated returns for our investors by being short duration, something not many multi-asset investors have done in the market. We did it quite successfully. But you also see here that the blue shaded area is now in the positive range. So actually, we do see that fixed income instruments are not as unattractive as they have been 1.5 years ago. So actually, we are starting to nibble into fixed income, to buy into fixed income, not excessively, but we are not as negatively positioned as we have been the 1.5 years before. And where do we buy fixed income instruments? You see that here on the right-hand side. On the right-hand side, you see the typical allocation of any fixed income benchmark. We in multi-asset, we don't use fixed income benchmarks. That's would just something if you purely buy into fixed income. You see it's well spread over different duration horizons. Yeah, typical average duration for a fixed income index, 4 to 5 to 6 years. How do we invest? That's our portfolio, the concept Kaldemorgen. You see the turquoise bars here. So we are really at the short end of the duration spectrum. So nearly all of our fixed income positions are in a maturity bucket of up to 3 years. What is the reasoning? The reasoning still is, you've seen that the inversion of the fixed income curve, you get more yield at the front end of the curve than at the back end. And we still think that central banks will be very hesitant to proactively bring yields down. So there's still inflation way above 2.5%. And as long as the inflation will stay where it is above 2.5%, 3%, we think central banks will be pretty hesitant to bring yields down. And that's what the market is expecting. The market is already expecting that yields are coming down. So we are intendedly positioning our portfolio at the front end of the yield curve. But we are also buying into corporate credit. What you see here is the weighting of corporate credit in the concept Kaldemorgen strategy, and also the average yield for investment-grade corporates in Europe. So on the yield side, you see that for quite a long time, the yields had been around 0 for investment-grade corporate credit. That was unusual, as I explained. We have been living in a very unusual world for fixed income investments. And you see that we actually slided down our allocation to credit here in concept Kaldemorgen strategy. You see yields moved up quite a lot, by 4 percentage points in just 1.5 years for European credit. And you see that in concept Kaldemorgen strategy, we nearly doubled our investment into corporate credit. So we start to reinvest not only into short maturity fixed income, but also corporate credit. So we do see opportunity. It's not super crazy interesting, but we see opportunity start to emerge in the fixed income world. Last but not least, the equity proportion. So on the equity side, it was the right strategy just to stay invested. Yeah, one of the big investment banks actually just put it this week, we only want you to stay. That was their title of the US equity outlook. Just stay invested. All the investors that say, oh, nay, we don't think that equities will perform. We do see a recession and so on. That was not the right call so far. Just staying invested on the equity side was the right call. And you see it for concept Kaldemorgen as well here on the left-hand side. We kept our net equity proportion quite unchanged over the course of the last 2 to 3 years. So net equities for our strategy, concept Kaldemorgen, between 40–45%. So the right strategy really there is stay invested in the equity market. As I said, yields on the fixed income market came up, but our return expectation for equities is still higher than the return expectation on the fixed income side. So stay invested. But what we did is we changed the structure of our equity portfolio. What we historically had was a bigger proportion of bond replacements. That's quite understandable. If the yield on the fixed income market is close to 0, you look for bond replacements on the equity side. That's typically dividend stocks and infrastructure stocks, because they do yield 3 to 5%. If your yield on the fixed income side is 0, you choose to go for yield on the equity side. But there's some yield back on the fixed income side. So the question we are asking ourselves is, do you still need bond replacements in your equity portfolio? Do you still need a big chunk of dividend-paying stocks, of infrastructure stocks? And for us, for concept Kaldemorgen, we took the decision that, okay, the yield is at least okay on the fixed income side. Perhaps we do not need as much defensive and infrastructure names, bond replacements as before. So you see that here in these bars on the right-hand side. In our strategy, we intendedly reduced bond replacements on our equity portfolio and actually build up digital and tech. even if I was joking, okay, AI seems typically as an end of the cycle development, it is driven by these big 7 names and it's not going away. So for our portfolio, we intendedly reduced dividend stocks, infrastructure stocks, and bought more into the tech names. So this is a theme, this is there, and this is something which is driving the market. So what's the result of all of that? What we are comparing here is our strategy, Concept Kaldemorgen, well known, one of the biggest multi-asset funds in Europe, compared to the biggest 40 other multi-asset funds in the market. And you see here, most of these funds, all of these funds are negative territory, most of these funds down 5 to 15%. Because of their fixed income investments. Most multi-asset investors are heavily still invested on the fixed income side, have been heavily invested on the fixed income side. And you see what we produced here in Concept Kaldemorgen, a strategy that is back at its all-time high. So with the flexibility we have in our product, with the changes we did in duration on corporate credit, with the changes we did on the equity side, the strategy is back as its all-time high. Just look around at equity indices, fixed income indices, any asset class you will find in the market. There's not much that is back to an all-time high. With flexibility and the right long-term allocation, we have been able to be back at an all-time high and to deliver what we think is important, long-term returns for our clients. And with that one, I will finish on the left-hand side. Concept Kaldemorgen being in the market for 12 to 13 years now, being run by a portfolio management team that is together for 20 years now, so quite experienced investors. We think flexibility, but the mix and the long-term perspective makes sense for every investor. We do see this barbell everyone is playing currently, money market on the one hand side, AI on the other hand side. Our answer would be just stick to what worked over the last 15, 20, perhaps 100 years, long-term allocation, long-term investment strategies, and that's what we delivered here for our Concept Kaldemorgen strategy. With that, thanks for your interest, and happy to take any questions afterwards. Thank you.